Hello, everybody, and welcome back. The Japanese stock market recently saw a new 33 years high. So many Japanese companies are posting record profits and have solid balance sheets. This has sparked the interest of many investors. Today, we talk about this and more with Dan Carter, lead investment manager at Japanese Equities at Jupiter Asset Management. So a warm welcome, Dan.
Thank you very much. Pleasure to be here.
Then Japan's central bank recently decided to keep interest rates below zero and meager bond yields to stimulate economic growth. Sounds like the same recipe as always in Japan.
Yeah, so what we're seeing from the Bank of Japan is a very moderate normalization of monetary conditions. So this is not exactly the same as before. The Bank of Japan has said that it is going to back off from buying Japanese government bonds to suppress bond yields, therefore allowing bond yields to rise and allowing a slightly tighter monetary condition to come about. But you're right, it's not a very significant change. It's not a very large or rapid change. And I think the reason for that is because the Bank of Japan sees inflation quite differently to other major central banks around the world. They're not inflation fighters. They just want to use inflation to normalize monetary conditions, I think.
Inflation has been above the 2% target the Bank of Japan set for 18 consecutive months now. Has Japan finally left the long-term deflationary environment?
We think that the inflationary mindset is starting to set in Japan. And we're seeing this in a few different ways. We're seeing consumers being maybe a little bit more expecting of prices to rise. We're seeing workers expecting to see some pay hikes coming through. And we're seeing producers and industrial users of other people's products, again, just expecting prices to be going up. So I think in general, yes, you're right. There is a shift in mindset out of that deflationary situation that we had in Japan for so very long. But we shouldn't dismiss the power of that deflationary history. And I think, we should expect Japan to continue to be a less inflationary market than many others. We're seeing inflationary pressures ease a little bit in Japan, particularly in producer prices. So it may well be that we've seen peak inflation, but hopefully we don't go all the way back down to deflation.
Inflation also prompts consumers to shift their savings from bank deposits into higher yielding investments. So how does this affect the Japanese stock market currently?
Yeah, so the logic there, I think, is strong. And that is that domestic savers, so households, when they're in an inflationary environment, need to protect those savings, need to protect their purchasing power. I think we will see this, but we haven't seen it yet, not significantly. Household allocations to the domestic stock market, for example, and therefore away from cash and government bonds, is very, very low. We haven't seen a significant shift yet. There are some significant changes that are going on with respect to the ability to save relatively large amounts of money on a tax-free basis, in line with some other places in the world, really just an evolution and an expansion of a policy that's been in place for some years now in Japan, that I think could help stimulate the shift in assets away from risk-free assets towards riskier but more inflation hedging assets. But I think really the pain for the Japanese consumer, the Japanese household, has not been felt for long enough and has not been felt severely enough. We think that is just about to change.
In June 2023, the Japanese stock market reached a 33 years high. How high is the share of low interest rates and the cheap Japanese yen on the success story?
I think low interest rates are relatively unimportant in the most recent good performance, at least in yen, so in local currency of the Japanese stock market. I think at the beginning of your introduction, you talked about record levels of profitability for the Japanese corporate sector. I think that's very, very important. So what we're not seeing in Japan is a significant expansion of valuations on the Japanese equity market. It's not that low interest rates have stimulated particularly high valuations on stocks. It is more the fact that those companies are delivering much more substantially now. So that's one thing. The other is really the way the interest rates perhaps have impacted is through the currency, which was the second part of your question. There are certain sectors in Japan, those export-dominated sectors, and in particular, we're thinking about the auto sector, that has been very strong year to date, and particularly strong since the early summer. And at least part of that is down to the fact that the yen has been very weak, which stimulates profits that have been repatriated from overseas. So I think in that sense, those sort of economic facts, i.e. a low interest rate and a weaker yen, have been meaningful, but there are lots of other things that are going on supporting Japanese market as well.
How have valuations developed as a result of the years-long bull market, and where are the opportunities for further growth in Japan?
So I think an appreciation of stylistic preference and leadership is valuable here. So up until really the end of 2020, asset-light, fast-growing growth companies, for want of a better word, were winning. They were doing well. They were attracting much higher valuations than their peers, which were much more asset-heavy, slower growing, perhaps higher yielding. Those kind of value companies were out of favor. What we've seen over the last couple of years is a 180 in that environment. So we have seen valuations on those more rapidly growing, more future forward companies coming down. Yet we've seen valuations on those value stocks, so the slower growing, more industrial perhaps, or extractive or energy related companies rise quite considerably. So what we saw was the jaws of valuation opening between these two styles, and more recently beginning to close, and whether they have totally closed, so therefore the next phase will be more growth loving or not, is a very open question. But we have seen an evolution in valuations, which means there's not such a large disparity between those two stylistic proxies.
An interesting observation is that Japanese companies are increasingly raising prices instead of absorbing rising costs. So what favors a stronger price position of Japanese companies currently?
Yeah, this is something that we're definitely seeing come through. I think partly it is that shift in mindset that I mentioned before, the fact that these price hikes are now, it's possible that they are passed through and sustained. So that is one thing. The other thing, though, is that the Japanese corporate sector is now more incentivized by profit than it's ever been. And this might seem like a strange thing because with our international eye cast over Japan, we always presume that companies are going to be highly profit focused. In the past, that has been much less the case. But from the pressure brought to bear by government and some other non-governmental agencies in Japan, I'm thinking most recently the Tokyo Stock Exchange, but also lots of investors, including ourselves, putting pressure on management teams to increase the priority of profit in their decision making. That has made management teams much more willing to push on prices and expect higher prices in the products that they're selling to at least maintain their own profitability and hopefully increase it than has ever been the case in the past.
Japanese companies have substantial cash reserves. And so how does this inflation affect their capital deployment strategies and their ability for future growth?
This is an interesting one because, again, this is where the logic and the reality, I think, sometimes conflict. So the logic would suggest that Japanese companies now have, large cash balances which are sitting there, typically in low risk deposits, making historically through a deflationary period, making real positive returns. And now that is not the case, surely they're going to be incentivized to spend that money and use it for growing their own businesses, capital investment, etc. I think that is too hopeful. I think the logic is strong, but the reality is that it is too hopeful. I think that historically, the reason why Japanese companies have built up those cash reserves is because they've just been very conservatively run. I don't think it's been an economic decision determined by seeking out those real positive returns. I think it is just financial conservatism. And I think insufficient pressure put upon those management teams to try and use that capital better has led to this situation where you have very, very large cash positions. So a shift to an inflationary environment, I don't think necessarily stimulates a huge amount of capex. That said, I do think that the increased pressure that is on the corporate sector to increase the productivity of its capital, it is very meaningful. So I think we will get this capital used more effectively. I'm not really sure that it's inflation that is forcing them to do it. And I'm not sure that capex is the way that it will be done.
Which sectors or companies in Japan can grow faster than average in light of changing consumer behavior? And what stocks are you currently buying and preferring for your portfolios?
We are not hugely positive on the Japanese consumer on the mid to longer term. In the short term, I think that there are a couple of things to be excited about. One is just that very delayed and gradual recovery from the COVID-19 pandemic and the return of external consumers, so tourists coming back to Japan. That is quite a meaningful boost to at least some areas of the consumer economy. So hotels, etc., should benefit from that. The other thing is that real incomes have been squeezed recently in Japan, and we hope that is likely to normalize from here. The time lag between inflation in prices and inflation in wages means that wages are catching up. So as wages catch up, that should take some pressure off the consumer. But this is all quite short term. I think longer term, we need to think much more about demographics. And therefore, within our portfolios, we have very little exposure to consumption. We have no retailers, we have no leisure companies, we have no food companies, etc. So we're very cautious on the mid to longer term view. There are other sectors that we think, are much brighter in their prospects in the Japanese equity market. One broad area, I would say, are productivity augmenting companies. So Japan has productivity, both of capital and labor, which is too low. It has an economic growth rate, which is relatively low. It has a supply of labor, which is going down because of the demographic situation. What that means is that Japanese companies need to allocate labor much better. They need to digitize, they need to automate. So there are many companies which are either business process outsourcing companies, staffing companies, or IT companies, which can help the corporate sector do that. And for those companies, I think the growth rates are going to be very bright indeed.
This was Dan Carter, lead investment manager, Japanese equities at Jupiter Asset Management. Dan, thank you very much for being with us today and sharing your insights.
Thank you very much.